the reason this has been a point of discussion is because I would imagine a lot post to '08, it was really tough to trade. You were constantly getting pushed out of trades, right? It was very noisy. They weren't making a lot of money, and so I think trend managers ended up pushing further out so that they were trading less and being kicked. Just they gravitated towards the thing that was working.
Well,
Well, I think it's probably even more insidious than that, Rod. Those who were focusing on shorter term trends went bust. Their returns were whipsawed and
Yeah, they're
they
whipsawed.
don't
there's
exist anymore.
that, but I also think, and we'll get into this in a second. So this aligns with everyone's intuition. Oh, things slowed down. And I think the expectation is, well, if you're fitting the full period, which we are now too fast for the way trends are today. And what I want to point out is there's a very subtle aspect of the math here, which is replication at the index level is two parts: the return of the underlying markets times the weights that those markets are being traded. And those weights are going to be dictated by the trend systems. If those short-term trend strategies are having no contribution to the overall P&L, it's going to look like they're not being traded.
That's interesting.
Right? So it could just simply be that short-term trend didn't do well in the 2010s and therefore had no contribution and therefore does not show up when you fit over that period. And we're going to see that.
It would
That's
show
a-
up in the return variance, though.
It depends. It
Right,
depends
it
on
wouldn't show
how
up.
on the relative variance, right? If you're using a regression-based process, though, that's trying to eliminate extra variables like lasso and try, right? It's going to ultimately, right? It might send those towards zero because it's just not contributing enough variance. It might, right? But we see this. We're going to see this in the next section as well when it comes to markets. And so I think there's a data, not a data problem, but I think there's an extra level of analysis that I would love to try to figure out how to look into here, which is, did people actually slow down? Or for all the people who are saying, look, replicating with slower things fit better, was it because people actually slowed down, or was it because the short-term trend system stopped contributing P&L? They were still being traded, but the P&L sort of flatlined with those systems. And I don't know what the answers are.
The longer the look backs on your trend metrics, the closer you get to earning the drift on the underlying markets versus earning the trend following series, right? I mean, at the limit, if your trend length is the same length as your series, you're only getting the drift, right? So, markets, especially equity markets, like there may have been a macro bias, which is that we've now got a Fed put. I believe a little bit more strongly in equities than I did before, and therefore I want to inject a bias without directly injecting a bias, right? So by lengthening your trend length, you are injecting more equity and bond beta into the portfolio, and that may have been either an explicit or an implicit goal of the managers.